Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, we are heading into a big week for commodities with markets moving events like US presidential elections, the Federal Reserve meeting and the Chinese National Conference meeting, which will decide on the stimulus measures. Well, the OPEC Plus has already delayed its planned output hike by a month in a view of softer demand. Meanwhile, geopolitical uncertainties also still remain a big concern, with reports of fresh attacks from Iran on Israel through proxy militia. To decode the impact of these events and more, we are now joined by Max Layton of Citigroup and Peter McQuire, CEO of Exim Australia. Gentlemen, hi, thank you so much for joining us. And Max, I would want to start with you. I want to start with gold first, and we've seen an all-time high into this one. How do you see the prices going forward, and what is Citi's target for the next 6 to 12 months when it comes to gold?
Gold's had a spectacular run this year, of course, up around 35%. There's been many different drivers, and I would say the different drivers are not the normal historical drivers over the last 10 to 15 years. You've had central banks really step up. You've had China really step up, certainly for the first half of the year, and that's transitioned into North American, European, global ETF buying in the third quarter of this year. China stepping back. On paper, the central bank stepping back a little bit. But overall, investment demand for gold this year has been super strong. It's come from different sectors, as I mentioned, over time. It's shifted over the last 9 months, exactly who's buying how much. But wow, it's been a spectacular year for gold investment demand so far, and we expect that to continue over the next 6 to 12 months.
So, Max, when you say that you're expecting the prices to go higher for the next 6 to 12 months, what's your sense on prices? What are your targets?
Yeah, I mean, overall, considering some of the data that's gone against gold, strong payrolls, big rally in rates over the last few months, it's been a very steady, positive momentum bull market in gold. And we haven't changed our forecast for some time. We've been targeting $3,000. Well, I think at least since the start of this year, potentially since the end of last year. And that is where we expect to be over the next 6 months. And we're expecting it to, I mean, of course, there could be volatility on the way up, but target remains $3,000 an ounce.
Max, also, how would you look at the silver prices? Because this one is outperformed gold. There is a deficit and there's a bull run into here as well. How would you look at the silver prices in 2025?
Yeah, so when we ran the balance numbers for 2025, for example, we assumed $40 silver, and then we adjusted the jewelry demand lower in response to higher price, adjusted the scrap supply higher in response to higher price, and we still come out with a deficit. So even at $40, we are thinking that $37, $38, $40, in that kind of range, we're still seeing that the silver fundamentals require investors to sell their stocks to clear the market. And that underpins our bullish view on silver, and we're targeting over the next 6 to 12 months, $40 an ounce.
Max, also, what's your sense now on the industrial metals? Because the last few days have seen some support continuing. Of course, the China stimulus is something that the street is waiting for. But where are you putting your bets?
There's a lot of things that can happen to metals, both bullish and bearish, and a lot of binary risks upside and downside just in the next couple of months. But taking a 6 to 12, 18-month view, we think the copper and aluminium in particular are going to do very well. Middle of next year, we've got copper at 11,000. We've got aluminium getting up towards the high 2,000s or almost $3,000 by the second half of next year. And both of those markets are underpinned by strong China-led energy transition demand growth, a lack of supply growth, and likely substantial investor interest in a global manufacturing recovery. And we think that will be that's the base case, certainly by the second half of next year and into 2026. And that's, that investors are going to express that view, in our view, through copper, and it's going to take aluminium higher with it. Zinc's got some special supply stories at the moment, which we're not assuming that they last, taking a 12 to 18-month view. So yeah, super near term, very difficult on base metals because For example, Trump may win the US presidency and then may proceed to do very large Section 301 tariffs on China very quickly in the first quarter of his potential presidency next year. And that would be a major headwind for metals. Our base case is that China responds to that kind of trade escalation, trade war escalation. But obviously that would, raise significant uncertainty about the degree of the global recovery in the second half, 2025, 2026. So, there's some water under the bridge between now and our base metals bull market call over the medium to long term to be had. And that's part of the reason we're so focused on gold and silver higher is partly because elsewhere, it's much more questionable. Gold and silver seem to work in most of the scenarios that we look at over the next 3 to 6 months.
And finally, on to the crude oil prices, Max, and these seem to be quite volatile in the last few days, especially with the OPEC and allies statement. And now, of course, we have all big data coming in this week. What is your sense? Where would you see the crude prices headed forward?
Sure. I'll start with where I think we're heading. The path to how we get there is very dependent on what happens in the Middle East over the next couple of days even. But we're heading towards an average price next year for crude oil of $60. That's where we think roughly the equilibrium is, considering the very high spare capacity in the market, considering the non-OPEC supply growth that we forecast is significantly higher than global demand growth that we forecast next year. These bearish dynamics, I think the market has generally moved towards consensus on. I would say our average price forecast is well below consensus. But I think we're on track. It's just in the very near term, there is a real potential for escalation that includes oil assets. To the degree that it is contained escalation, I think selling those rallies, especially those clients who are significantly exposed to crude oil, given our forecast of $60 base case, I think selling those rallies is our recommendation.
Max, a final question, and there is so much happening in the month of November, the US Fed meeting, US elections, China Congress meeting. How would you look at the month of November and what's expected on commodity as an asset class?
Great question. I think most of our clients are in wait and see mode, because it's not just, even if you can predict all of these things, like you predict material China easing, let's say you predicted the election one way or the other, or you predicted the Fed meeting, it's not necessarily, any one of those things could go against you and blow up the trade. And secondly, even if you predicted the election, you aren't exactly sure whether, for example, a Trump presidency would result in more sanctions or no sanctions, whether there's tariffs or small amount of tariffs, large tariffs, small tariffs. You're not sure if there will be potentially geopolitical de-escalation or massive escalation. So you don't know exactly which policies will be implemented essentially by the next US president. And so I think a lot of people are on the sidelines. What we're looking for is material China easing that is eventually bullish. We're looking for further US labor market deterioration and the Fed to eventually get ahead of the curve over the next, say, it's not going to happen in the next month, but we're expecting that to happen. I think the wild card of the three is, if Trump wins the presidency, exactly what does he do? And that's the tough one, which even if you feel pretty strongly on the other two, like China and the Fed path, that one is what creates some substantial uncertainty around the view. So yeah, we will see. But certainly I think precious works in our base case scenarios, and whichever Trump policies are put in place, it should also work.
We understand that, Max. There's just so many ifs and buts, but we'll know it very shortly on where all of these data events do take us in this week there. Thank you so much for joining us. But coming to you, Peter, what's your sense, first of all, on this very big week, and how are you making your bets across commodities as a sector?
Well, I think, Manisha, we sit here and we digest where the next 24 hours can take us. And naturally, then you're rolling into Thursday, of course, as far as Fed policy. So all of those moving parts need to be considered. I think that one of the big things is, if it is, and building on Max's comments, as far as if you do see a Trump presidency, where does that leave us? And there's a lot of uncertainty as far as how that unpacks. And so we understand the tariff situation. So we've got to get through the next 24 to 36 hours to get a true indication of the momentum, and then appreciate, how the rest of the week looks at it, and naturally how the Fed will look at it from who's going to be possibly in the White House if it's announced by then.
But Peter, that's a short-term view, and there's a long-term view as well. Would you say that this week has a possibility of changing the long-term view that people have on commodities?
No, they could, Manisha, but I think it's been relatively, look at the asset classes. Look at that. If you look at, first off, precious, it's just been enormous, over this year and really over the last probably couple of years. You're looking at crude oil, it's very choppy, but, it's still got the potential to rise higher with the geopolitical concerns you've got at the moment. You've got, again, hurricane season and that sort of thing moving in for short-term trading. But I think overall, the storyline, it's going to be certainly a market that you want to have in any portfolio leading into 25 and 26 is the commodity sector. So I don't think it's, I think that its best days are ahead of it. Plenty of building going on across the world, plenty of demand. And I think that it's certainly, going to be a hot market to trade again over the next, 18 to 24 months.
Absolutely. Peter, so if you had to make a portfolio right now for the next 6 to 8 months to 12 months, let's say, where would you put dollar index? How would you look at precious metals, industrial metals, and then energy?
Well, US dollar index, Manisha, I think, it'll probably sit around that 102 to 105 sort of handle over the next 6 to 12 months. But then again, it could run wild if something depends on who's running America and the US and the state of the global economy. I wouldn't be surprised to see, the labour market is really shaky in the US when you're seeing that 12,000 NFP. So you've got to look at gold. Naturally, the precious metal market has just been enormous, and that's somewhere you've got to find a home. So there's the first part. Yes, base metals, to have those and the producers in that space. Crude oil, you can't be without it because, 100 million barrels a day. If Trump comes in, what that's going to do as far as, a drill, baby, drill mantra that he keeps on talking. You're looking at natural gas production in the US. They're going to be #1 in the world for LNG. So all of that space needs to be really considered and have again in your portfolio, Manisha. So, it's a place to be, and you've got to be very focused on it.
Given the kind of situation that we're in, of course, a lot would change in this week itself, Peter, but given the fact that there are geopolitical tensions, the rate cuts perhaps will continue, if not at the same pace, but at some pace going forward. How are you looking at the overall sector then? Would you still look at 3,000, as Max was telling us, 3,000 next year is a possibility, $40 a silver is a possibility, not so bullish on crude because, one, the demand is not picking up and the supplies are enough. How would you look at then including these in your portfolio? Are you equally bullish on metals when it comes to that?
Well, I think so. Yes, very much so. I mean, if you look, let's look at precious first off. This time last year, you're at, 18, 1900. Now you're at 28, nearly at 28, 2750. So yes, it could be a 3,000, could be 3,000 handled by New Year's Eve, Manisha. It depends. Many factors go into that. Geopolitical concerns, a new presidency, who knows, as far as, Fed policy. So yes, certainly gold, 3,000 plus over the next 12 months. Silver, it's got the capacity again to be a $40, $45. I mean, the structural situation as far as silver and where we see that over the last decade underinvestment, and as Max highlighted, you're looking at the big picture. It could be a $45, could be a $50 ounce. And I'm not, spruiking that number. I'm just saying it's quite possible because I think the overall situation is going to be very, precious metal centric. And then if you're looking at crude, well, it could do anything. you throw a war in there or throw some other issues, it could be just as easy 60 or 100, Manisha.
Oh, well, absolutely. I get your point there. So the dollar index you said is 102 to 105, but gold and silver are definitely to have in your portfolio. Couple of metals which can actually go further and have given good returns in the last 1 year as well. Crude oil prices, as Peter tells us, could go anywhere, and that's a difficult one to add into your portfolio in sense of profits there. Peter McGuire, thank you so much for joining us with your sense on all of those commodities. But with that, it's time for a short break. But don't go anywhere. We get you all the latest from the renewable space and also what to expect going forward. Stay tuned.